Welcome to the Tesla Daily News podcast for December 20th, 2025. Today, we're tracking a major regulatory threat in California tied to Autopilot branding, fresh questions around Cybertruck demand and end-of-year deliveries, and a couple of investor flow headlines that can move Tesla sentiment fast. Story 1. California regulators are putting Tesla's ability to sell cars in its biggest U.S. market on the line. The hook is simple. The California Department of Motor Vehicles is warning Tesla to change how it markets Autopilot or risk a 30-day sales ban. Here's the context. Tesla's driver assistance features are a core part of the company's tech narrative and, importantly, its software margin story. But the word autopilot has long drawn criticism because it can be interpreted as implying more capability than the system provides. The key detail from today's reporting is the severity, a threatened 30-day suspension of Tesla's license to sell vehicles in California if advertising is deemed misleading. Investor impact. Even a short ban would be less about lost unit volume and more about headline risk and regulatory precedent. California is both a large EV market and a bellwether for other states. If regulators force changes in marketing language, it could also affect software attach rates and consumer expectations around full self-driving, which many investors treat as a major part of Tesla's upside optionality. Takeaway. Watch for whether Tesla adjusts language quickly, appeals, or fights it. The market will likely price the risk based on how contagious this action looks beyond California. Story 2. SpaceX buying Cybertrucks is turning into a demand signal and a governance question at the same time. The hook. Reports say SpaceX has been purchasing Cybertrucks in meaningful dollar amounts, potentially to support Tesla's end-of-year figures. The context is Cybertruck's role in Tesla's product mix. The truck is high-profile, but investors care about whether it can become a steady, high-volume, profitable program, not just a halo vehicle. Details from today's coverage. One report describes SpaceX buying tens of millions worth of Cybertrucks. Another version of the story frames it as using internal orders to juice end-of-year sales, with a suggested ceiling of up to about 2,000 units. Impact on Tesla. On the positive side, deliveries are deliveries and fleet orders can stabilize demand. On the negative side, if investors interpret this as demand weakness or left-hand selling to right-hand, it can hit confidence in Cybertruck's true consumer pull-through. It also raises corporate governance questions, even if legal, related party optics matter when a product's demand curve is under scrutiny. Takeaway. Investors should watch Tesla's next delivery report and any commentary that clarifies Cybertruck order backlog, production rate, and discounting or incentives. A clean story is fleet adoption. A messy story is internal demand support. Story 3. Cathie Wood's Ark sold Tesla shares, and that kind of flow can move the tape. The hook. Ark Invest trimmed Tesla again, with a reported sale of 23,110 shares, roughly $11 million. Context. Ark has been one of Tesla's most visible long-term bulls. So even modest trims tend to get amplified across Tesla social media and trading desks. Details. The reporting focuses on Ark selling Tesla while increasing exposure to crypto-linked plays like Coinbase. Impact. This does not change Tesla fundamentals, but it can influence short-term sentiment and momentum, especially in a market where Tesla is heavily traded by retail and thematic funds. Takeaway. Treat this as a positioning headline, not a thesis breaker. The bigger question is whether broader growth tech flows are rotating away from EV names and toward AI and crypto beta. Story 4. The EV competitive backdrop is shifting, and it matters for Tesla's pricing power. The hook. Lucid stock hit a new low, and the company moved to reassure investors about growth plans. Context. Tesla investors watch weaker competitors for two reasons. 1. It can signal soft demand in the high-end EV market. 2. It can also mean less pricing pressure if competitors are forced to pull back spending. Details. Today's Lucid coverage is explicitly framed around headwinds in the US and investor reassurance after the stock's decline. Impact on Tesla. If EV demand is choppy, Tesla's scale and cost structure usually give it more flexibility to adjust pricing while protecting volume. But persistent demand softness can still pressure industry margins and keep incentives elevated. Takeaway. The near-term Tesla question remains, can the company sustain volume growth without sacrificing too much automotive gross margin? Story 5. Grid constraints are becoming the limiting factor for charging expansion, not just hardware. The hook. Circle K's managing director in Ireland says in some areas the grid isn't strong enough to connect service stations for EV charging. Context. For Tesla, charging is both a moat and an ecosystem strategy, especially as more automakers use NCS and as Tesla expands its charging network internationally. Details. Circle K describes difficulty getting certain locations connected to the grid, implying that even willing retailers can't deploy fast chargers quickly. Investor impact. This supports the idea that charging growth is increasingly a utility infrastructure problem. That can slow EV adoption at the margin, which impacts the whole EV market, including Tesla. But it can also strengthen Tesla's strategic position if Tesla's scale and experience help it navigate permitting, interconnects, and energy storage pairing. Takeaway. Watch for Tesla energy and supercharging integration opportunities, including pairing fast chargers with on-site storage to reduce peak grid demand. Story 6. The energy transition narrative continues to strengthen, and it points directly at storage demand. The hook. New data shows California's fossil gas use declining sharply, with solar plus large batteries filling the gap. Context. Tesla's energy storage business has become a key second engine that investors increasingly track alongside vehicles and autonomy. Details cited today. California fossil gas use in the first half of 2025 was reportedly down 18% versus the same period in 2020 to about 45.5 billion kilowatt-hours. Impact on Tesla. As grids add more solar, they need more storage for evening peaks and reliability. That's the use case for utility-scale batteries like mega packs. While this article isn't a Tesla contract announcement, it supports the demand backdrop that can drive Tesla energy revenue growth and improve margin mix if deployments scale. Takeaway. For valuation, any sustained acceleration in storage deployments can help diversify Tesla away from pure auto cyclicality. Quick recap before you go. The biggest near-term risk headline is California's Autopilot branding fight, because it could set a precedent and create real sales and reputational friction. On the demand side, keep your eye on Cybertruck delivery optics, especially the SpaceX order story, because it will shape investor confidence in the program's momentum. And in the background, the grid and storage stories point to a long runway for Tesla energy if policy and infrastructure keep moving this direction. For tomorrow, watch for any Tesla response or legal update on the California DMV warning and any additional reporting that clarifies Cybertruck inventory, incentives, or delivery volumes into year-end. If you found this helpful, subscribe to the Tesla Daily News podcast and follow for a fresh, investor-focused roundup every day.